Hi, everyone. Welcome back to Mantle Mondays. My name is Amar Varma, the co-founder and CEO at Mantle. Today, we're diving into the world of family offices. I'm joined with none other than Joshua Berkowitz, who's the managing principal at Burkocorp. Joshua, welcome.
Thank you for having me. Do they know that we're recording this on a Tuesday? Is that allowed?
We can edit that part out, but yeah. Before we dive into things, I'd love to hand over the mic so folks listening, watching can learn a bit about who you are, where you've come from, and where you're headed.
Cool. So thank you. My name is Josh Berkowitz. So I'm here, I suppose, because I run my family's investment office, Berkocorp. The office sort of started in the late 50s. My grandfather was a real estate developer in Vancouver and built a bunch of apartment buildings. And then the next generation built and bought a bunch of retail centers, industrial buildings, turned into a pretty sizable portfolio 60, 70 years later. If you know anything about Vancouver's real estate market, you did well almost no matter what you bought. So that was the very fortunate position I found myself in. Candidly, when I grew up, I thought I would be a real estate developer myself. Wasn't meant to be. But long story short, we restructured the family business. And so I took over the office in 2020. And I took what was just a real estate business and turned it into what is now a very diversified family office. We invest across asset classes, private equity, venture capital, hedge funds, some public stuff, still own and operate the real estate ourselves. And so, have to some degree, I sort of say it's like an endowment-like approach to this. We're very diversified. We are disciplined in how we approach making long-term commitments and our pacing and our consistency and backing managers for many fund cycles. But at the same time, we try to bring some of the benefits of being a family office and having more flexibility in our ability to sort of underwrite and understand weird things that maybe the institutions find it harder to do.
Let me pause you there because I think you said a few things that are natural speak for yourself and maybe some of the folks out there. But for most people, I think it's interesting. When you say endowment like, and we deal with endowments, offices, fund of funds, all these folks. I think you have an acute sense of data-driven analysis and activity that's second to none. And for those out there, when there's a data question, Josh is the first person that we call to get insights on it. Maybe just break down a bit of why that is, where it came from, and help us understand.
Sure. So, I suppose by background, I started as a management consultant. My dad has a PhD in statistics. Around the dinner table growing up, we would dissect studies, and he would tell us why all the studies that were written up in the newspaper that day actually did not mean what the newspaper said they meant. And then, post consulting, I was a private equity analyst. So, the entire job is really analyzing and ripping apart data, and then later in the tech industry as well as a product manager. So I think I had the background to do it. I also think it's probably worth talking about. Yeah, when I said an endowment style approach, what I mean and what I think most people mean when they say that is this very famous CIO, David Swensen of Yale. I think he joined Yale in the 90s and invented this approach to investing, which really it starts from what is the purpose of an organization? Given the purpose of the organization, what kind of funding requirements does it have? Given those funding requirements, how can we set up governance to allow us to have the most flexibility and sort of freedom to invest in things that allow us to achieve those goals? Then if you keep on down the list, then it becomes about asset allocation. How do we want to split up between debt and equity? Within debt and equity, private, public. And then given that, how do you do manager selection? He wrote this up in a book in the early 2000s, laid out the entire thing. It's a pretty dense book. You probably learn it in some college classes if you're in business school. You can buy it today. It's still one of the very few books I go back to all the time because every time you read it, you learn and understand different things about how this industry works. And there he really laid out how he does it and how he thinks about it. Also how to analyze funds, how to analyze pacing, how to analyze all of this stuff. It's out there for anyone to read. Very few people actually do read it. And if you read it, probably don't even get through it or understand half of it. But quite frankly, that's where I learn most of what I do from. It's laid out right there, and I think it's just a matter of taking advantage of it.
Is this the equivalent of the value investing book for endowment?
Uh, a little bit. This is probably more technical than that. Uh, there's a few value investing books, and most of them are like the very famous one is,
Intelligent
do it.
Investor,
Yeah,
Ben
that's
Graham.
like, sort of calculate a bunch of ratios. And if you sort of stack rank the public markets by these, by like book value to market cap or something, invest in these. And I think that worked for a few years. And then everybody discovered it, and you know, the alpha went away. The institutional investor book is it's not designed to say like, hey, how do you invest to find alpha? It's designed to say, how do you find a style of investing that best fits the purpose of the organization? And how do you like think about that question really rigorously, so it's not just a guess, so that you have a whole bunch of like, mental models for how to actually achieve that, right? And so some things go like, if you're going to invest in an illiquid asset class, you better get paid for it, right? Like you can't touch your money for 10 years. Um, so you better believe that you're getting paid for that. And then if you're going to do that, how do you manage that liquidity, right? So in most endowments cases, they're paying 4 to 5% of their cash to the school they're attached to, or pension funds case, the obligations that are similar. How do you manage your cash flow so that you can be in illiquid asset classes that hopefully will give you a risk or give you a premium return for that liquidity? But how do you manage that given you have cash needs? And how do you manage the risk portion of that, right? Like if the market goes up and down and you still have to pay out the 4 or 5%, uh, how do you manage that? And so how do you fit all of these? Some asset classes are more correlated with others. So you got to balance the correlations between the liquid and illiquid asset classes, and sort of structure all of that so that your investments does the thing you want it to do. Right. And so for big institutions like an endowment, a lot of the challenge is making all your stakeholders happy. You have people who want to spend money every year. You have investors that want to invest in all the best opportunities every year. Um, you have many different people who feel like they should have control over how this money is spent and invested. So you have to put governance in place so that the system doesn't break and it all pointing guns at each other every year. So that's how they do it. At a family office, it's much easier, right? Because you have one principal who's saying like, these are our priorities. How do we invest in these priorities? So I have in that sense, I have a lot more flexibility than an endowment or foundation or any institution does. Nonetheless, once I say, okay, this is our goal, how do we achieve it? All of the thinking from there is very similar.
Got it. Got it. Got it. Got it. What's been some of the discovery you've had over the last 5, 6 years now to really be like, Yale model seems instrumental. There's probably some operational stuff. And then I think in our experience in doing some of this stuff, there's a lot of software that's come into play now, and ability to use AI and maybe bridging some of the alpha, right? So maybe dive into those
Totally.
domains.
Let's do it. So I think let's talk about like investing. We can talk about sort of like the tools to do investing afterwards. So I think like the macro thing I've learned over the last few years doing this is that like most people are investing not to lose their job, not to make money. Like they're literally in this just to stay employed. On the
Mm.
margins, they would like to make more money than less, but primarily their like organizing function is like, I want to keep doing what I'm doing. Why is that the case? It's because most people are not investing their own money, right? They're investing somebody else's money. And so if you're investing someone else's money, yeah, some people in the industry are compensated with carry, and therefore they do have some incentive to outperform. But I think that's a minority of roles, and in those roles, often the carry relative to the management fee, or like the ability to keep doing your job, is far weighted to keep doing your job. There's a saying, right? Like being consensus and wrong is okay. You keep your job, right? If everybody thinks the market is going to go down and you sell and the market goes up, you actually keep your job. But being contrarian and wrong means you get fired, right? So most people who don't have an incentive to think for themselves and do something that's risky, right? And so you have an entire industry that's built on that premise. And so what that means is every investment product sort of looks the same, right? Like every private equity fund is a 10-year fund that has between 5 and 15 companies in it, that invests over the first 3 years and sells them after holding them for 5 years, and charges 2% management fees and 20% carry, and is roughly compared to every other private equity fund that it's next to. And if they want to hold these things longer, they have to, they've invented new continuation funds. And so they all work roughly the same way. And then they're all roughly doing the same thing. And then if you were in an industry where everyone's doing roughly the same thing, everyone gets roughly the same returns. And roughly those returns fall over time until they become average. And like that story is just in the private markets and in some ways the public markets, like over and over and over
Let me
again.
let me chime in there because I think you say something, and I always like for people to really dig in on a couple key pieces. Being contrarian and wrong is like game over. Consensus and wrong, you're okay. Consensus and right, you're okay. You get the right to play another role at tomorrow's game, right? But the most successful people I've ever seen in life and business are the contrarian and right. And this is like the 2x2 matrix of being contrarian and right is the upper right quadrant. Maybe spend a bit more time on how that thinking evolved for you, because I don't view you very much, having known you a bit, as a consensus driven person on some views, and you're generally contrarian. Doesn't mean you can't be convinced otherwise, but just you start from that place, and I love it. And maybe just dive into that.
Uh, I think you're giving me a bit too much credit, actually. I say that there's two ways to come to run a family office, right? There's the first one, which is you are the wealth creator. You started a business, usually you sold it, and now you're an investor. Or you're like me, you got lucky, you got born into it. Congratulations, I won the genetic lottery. Let's take like the first case, right? The first case is you're an entrepreneur who does it. Often those folks are happy being the most contrarian, right? Because by and large, to start a business and succeed, like you're banging your head against a wall your entire life. You're used to other people telling you no, or that you're weird. And so for those folks, they're very happy being contrarian. In fact, they're probably happier being contrarian. But the classic failure mode for an entrepreneur turned investor that does that is like they're contrarian and wrong, because they're like, I've succeeded at everything in my life up until this point. I'm God's gift to operating. I'm going to be God's gift to investing too. I'm going to do everything weird in my way. And they're probably going to be contrarian and wrong because they're going to come to it with like that sort of a bit, in starting a company, you can kind of outwork your problems to some extent, right? Like if you make some mistakes, you can just get up and try again, or work, like bang your head against the wall until it falls over. Like you can't really do that in investing. If you make a bunch of bad investments, like guess what? You lost the money. Hopefully you didn't lose all of it. So that's the classic failure mode for like an entrepreneur who then becomes an investor. For someone like me, my first order of business is like, don't lose the money, right? I didn't make the money. I can't lose the money. And so when I started doing this, it's like, well, I don't want to rock the boat too much because God forbid, the young kid takes over and goes and makes a bunch of crazy decisions at the beginning and loses it all, right? And I also didn't have the confidence to know that the industry worked the way I described it. So my first few years are having an inkling that what I'm saying to you is correct, that like the industry is all fucked up, that it shouldn't, that nobody is thinking for themselves, that everyone's just doing the they don't get fired thing. Kind of knowing that in the back of my head, but not really having the confidence or the sort of like ability to say, okay, I'm going to go do something else. Luckily, we had some pretty successful first few years when I was running it. And so that sort of like one bought me the confidence to say, I'm going to go out and do weirder things. Plus, even at the beginning of me running the office, I did some weird things, and those weird things by and large have worked pretty well. And so it's more like, gaining
What are
confidence
one
to
or
do
two
weirder
of those
things.
weird things that you did?
Invested in a couple holding companies that are, kind of like either, you can think of them like, if you're familiar with Constellation software, like Constellation light things. They've done really well. They don't fit any model. They're not private equity. They're not venture capital. They're a weird thing. Invested in some super weird, funky secondaries things. There's lots of early stage, small venture capital that looks very weird and non-institutional. A lot of that. Litigation finance stuff. We are like with the relaxed Arizona ABS rules. Litigation finance firms can do some really interesting, funky things. Crypto to some extent. But like, and sort of all of those things don't fit a mold. Or don't fit a sort of a typical institutional allocator sort of like hat. It doesn't fit into a bucket well.
It's hard to go to your committee of peers and be like, that weird thing nobody's thinking about, we're in. We're
Totally.
all in.
Totally.
Yeah.
Right. Back to the contrarian, right? Right. Like not like even if you have an investment committee, you even having to stop and explain it to them. If it's really hard to explain it to them, just what it is, never mind why you should do it, that's a strong reason not to even bother because you just don't want to deal with the brain damage.
I think that's great insight for people on some of the approach to how you think about things. You're one of the most data-driven people I've met, um, and I feel like it contributes to maybe something in the operational alpha or something, right? Maybe talk a bit about how you've implemented that, maybe some of the AI practice, some of the things that are there for you. And I know you have a very interesting setup, and it's it's world class, and it blows my mind every time I see it.
Okay. Thank you. I think. So yeah, for me to sleep at night, I need to know with a high degree of confidence, like how all the cash is flowing through my business. Partly that's because if you waste cash or you have it sitting there doing nothing, it's massive tax drag and your returns go down. Partly it's that one of the nature of private market investing is that you make capital commitments. You say, I'm going to invest $10 million in this fund. Well, they have 5 years to ask you for it. And so if you're not careful and make sure that you have that cash available when it gets called for, you're in trouble. At the same time, if you just leave the cash sitting in cash, you will destroy your returns. So that's one part of it is I want to make sure I always know how that's working. And then the other part of it is if I'm going to be intellectually honest with myself, I need to be able to understand how well am I doing? Like what investments are doing well? What kinds of investments are doing well? Should I focus more on venture capital? Should I focus more on this weird niche private equity stuff, like small cap stuff? Should I co-invest more? Should I go after bigger funds? Should I go after smaller funds? If I want to, get my cash flow timing dialed, like how can I model my cash flow better so I can hit my target allocations better? There's all sorts of questions where if you answer them with a higher degree of precision, your returns will just go up, right? And also you'll make better investment decisions. So I think like many people who do this job, I have a massive spreadsheet that like pretty much everything dumps into. It is kind of an unfortunate state of affairs that is still how most people are doing things. Up until Mantle, I would spend many, many hours collecting all the data that would go into that spreadsheet manually. Now Mantle just sits open in my as one of the tabs in my browser all day long, and all of the information is there. I mean, I have Attio and I have ChatGPT and Granola and a gazillion other things that sort of like make my life easier in terms of doing diligence and keeping tabs on all the opportunities in front of me. I don't think that makes me that unique and special. It's just like, why would you not use that stuff? But you put it all together, and look, I try to use the cash flow model to make sure I'm achieving my target allocations as sort of tightly as possible without causing any cash drag and sort of keeping cash I don't need sitting there. And then having great tracking in places like Mantle and then do like sort of taking that data out and then analyzing it well so that you can sort of have a good sense of like what vintage years are driving your returns. Are small funds performing better than big funds? How many companies are driving your returns? How much overlap is there in the funds you're in, and how much correlation there is? All of those things are sort of just to try to make each decision incrementally better.
Awesome. There's a lot in there. I think, if I could speak a bit here, if you're looking for a world class setup on data and workflow and tools, like this is it. One of the examples, one of the best ones I've seen. And then maybe a bit about you talked about investing in some of these funds. Maybe talk a bit about the approach there, signals of things you've been successful with, yellow flags, those types of things.
Sure. So I think this is probably easiest to talk about in the context of venture capital, because if we talk about other things, I'll spend too much time just discussing what it is instead of why it's good. So venture capital, there's like, I don't know, a few thousand venture capitalists in the world right now. There's probably a few hundred fund launches every year. There's all the big names we've all heard of, and then there's a few thousand of the little guys. If you can pick the right little firms, you'll do incredibly well, but there's thousands of them. You have to sift through them. In many cases, they're all fund ones. You have very little data to do any underwriting on. And there's tons of them. And so to know what good looks like, you also have to meet them. You have to meet them at the exact right point in time. So to do venture capital well, one, I think you need to spend a lot of time doing it. You need to meet probably a few hundred venture capitalists through the time. You need to invest in a bunch of them so that you build a relationship with great GPs. Venture capital is a unique asset class in that everybody works together, right? Like in buyout, a single investor will own the vast majority of the equity in a company, and there's no other investors involved usually. And so if you actually ask what a buyout fund thinks of a peer, mostly they won't know because they don't work together. Venture capital is like a big gossipy community. Like, yeah, there's a few thousand venture capitalists. They all kind of know each other. They all sit on cap tables with one another, especially if they're in the same cities or, focus on the same sectors. There's people they like to work with and people they don't like to work with. They all have well-known reputations that you can only understand what their reputations are if you're like in the club. If you're an outside LP, probably no one will tell you what they really think. But once you're on the inside, it takes 5 seconds to find out what people really think. And so given that like nature of the business, you need to spend a lot of time doing it. If you wait 10 years to see someone has an amazing track record, sort of definitionally, you're doing it wrong because that means their track record was created 10 years ago when they were a different human being and probably in a different city, in a very different market, and doing a different thing. You have to meet lots of people. You have to meet them when they're fundraising. You have to know enough folks in the industry so that you could rapidly sort of reference them and know what what the name on the back of their shirt is. Like, what do people say about them when they're not in the room? You have to talk to a lot of founders to get a sense for what their taste is in founders. And you have to have know what great looks like. I remember when I did this job at the beginning, you would meet all these VCs and like sort of to be a venture capitalist that has raised a couple funds, like by and large, you're a pretty exceptional person. Like if you're not, you wouldn't have gotten that far. And so me starting this, I was like, wow, everyone I meet is so smart. I want to give them all money. What that means is I just had to raise my bar even further, right? Because
I think I'll just pause you there for a sec. The number of people that I've known, and I've been around a few decades now, that have made one carry, two carry across vintages, and three carry across decades. Very small number of people.
right. Well, the stat that scares me is that like the top quartile venture return has never been above three net, like ever. And if you can do private equity reasonably well, you can get 2x net. And private equity takes about 5 or 6 years of money out, whereas venture capital takes like 10 years, right? So venture capital needs to have like 3x net in order to be worth the brain damage, quite frankly. So it's scary. At the same time, then you go look at the amazing returns. Like I'm going to have a couple funds in my portfolio right now that I would be shocked if they're anything less than 15x.
Wow.
There's one fund in particular that it's 3 years old and it has 3 companies that have raised over $2 billion. It's a seed fund. And all of them look like they're all AI companies that are ripping right now. And so when you find a special one, basically what happens is like if you sort of find a mature venture book from an LP, say you do 10 funds in a year, you'll have a whole bunch of, and hopefully it's a good LP, you'll have a whole bunch of funds that are clustered between, call it 1.5 and 2.5. Maybe you'll get a blended 2.25 between them all. And then you'll get one fund that's a 10x or a 15x, and that will add an extra turn to the rest. And so hopefully blended across all of them, you'll end up with 3x, or 3.2x, which is sort of what you're hoping for, which should get you to a 15% to 20% IRR across all of it. But yeah, it's really hard. And the other thing that's frustrating about it is like most family offices that do venture, say you make a commitment in 2022. So I'll take the venture capitalist, call it 4 years to call the capital. So they'll be investing through to 2026 because of the J curve, because like all the fees start at the beginning. In 2026, suddenly you'll have finally contributed all of that money, and it will show up on your books as $400,000. Hey, why are you down 20%? Well, you're down 20% because these businesses take a long time to grow, and the fees start at the beginning. And the family office goes, well, I hate this. I'm not doing venture anymore. And then they give up. And that's sort of like the most classic venture failure for family offices. So you have to have a lot of patience. You have to be able to look beyond the headline numbers to understand what's really happening with these companies. And you just have to be really patient, which I'm sure you know better than anybody.
Yeah, there's a lot in there. I guess one of the other things that we've seen a lot in this domain are the sizes of teams. You're kind of the busker one-man band in all the best ways that can be. Maybe talk a bit about composition of team and why it's that way and how you're able to do that.
Sure. So first, I'm a one-man investor, but I have lots of folks that I work. I have an amazing back office, middle office team that makes my life easy from an administration perspective. And I have tons of folks that I work with that advise me and send me deals and that we underwrite things together. But I'm the one-man investment committee and one-man sort of decider. Why does it work? Look, I think there's pluses and minuses to my approach. I don't think it's just good. So I think I should rather just think of it as in terms of trade-offs. So on the positive side, if there's something weird or hard to understand or hard to get conviction in, only I have to understand it and only I have to get conviction in it. I don't have to convince somebody else, get them excited about it or get them interested in it. That makes my life a lot easier, right? One, it's my money. And I'm always going to care more about my money than somebody else is going to care about my money. And so
For
I
sure.
care more, right? I think about it. I dream. I go to sleep thinking about these things. Every one of the GPs I back values the fact that it's my money, right? I'm not giving them advice as some institutional person who doesn't really care and that will get fired tomorrow or move on to a different job. I will be the person who speaks for the money until the fund is done, and I care about it, unlike other partners. And so I think that can make me a more valuable LP as well, just because they know I'm at least, generally speaking, their entire career is riding on their fund, and I care up there with them. And also what that allows me to do is when I say yes, if I say I'm in, I'm in. There's no other BS that they have to deal with or an investment committee or whatever. The other thing I'd say is now that this part of the market is developed enough, like I kind of have this like syndicate of other folks doing similar things to me that give me superpowers, right? Like in any given day, I've probably texted or called like 5 other LPs that do similar-ish stuff than me, and they know what I like. I know what they like. Sometimes I'm just calling because I need to think out loud. Sometimes they're calling me because they need to think out loud. Sometimes I'm calling to tell them they're a moron. They're calling to tell me I'm an idiot. And so even though I'm a one-man team, like I don't
There
feel
you
like a
go.
one-man team. And that also helps underwriting things, right? Like if you're looking at a venture capitalist, maybe they have a portfolio of 30 founders they've backed in their career. Well, in order for me to get to know them, we have to call those founders and say, like, did they help you? How do they find you? What do you think of them? Would you let them invest again? Would you all sorts of questions you can ask for a reference call? Well, if they have to give 50 reference calls, like you're really gonna exhaust those founders. So I actually think GPs should want their LPs to work together because it makes their life easy.
Very cool. Um, Maybe switching gears a bit, what does this look like in 5 years from now? Is it a is it an AI agent moving
Thing.
everything? Is it you? Like what's your guess?
It's hard for me to believe that the human part of this business is ever going to go away. But certainly, I want all of the administration to go away. Like, in an ideal world, I could log into Mantle. It would tell me everything relevant that happened with my portfolio in the last week, month, day, whatever, along with all of the data that I need that I currently, have to. All of that part of the job would be gone. But in some ways, like this is kind of a sales job, right? Like me selling myself, them selling me. Um, you're really trying to figure out who the human is on the other side. So I think as long as the other investors are humans, as long as founders are humans, then the fundamental job of investing will be humans, at least in private markets where relationships matter. Nonetheless, if you have AI agents getting rid of all of the overhead and everything else, and you can spend all of your day thinking about what's the world going to look like, and are these people the right people to go execute, um, the job would get a lot more fun and probably be a lot better at it.
Yeah, there's these concepts now. And AI has all these fun concepts, right? The look ahead, right? And look ahead was always a simple math coprocessor thing, but now it's like we can look ahead infinitely to all the simulated outcomes, and if you knew the best one, you'd just pick that one thing and have no diversification, no nothing, right?
Right.
You just end up there, and
Well,
it's like
it's the Back to the Future thing, right? Wouldn't you want to go back and get the almanac that tells you the sports scores for the next 50 years, and then you can bet
that's
on
right.
that and become Biff Tannen. So sure, I would love that. I mean, but I also think there's like a bit of an adversarial element to this, right? Like if everybody has, like right now, every private market LP is using this thing called Harmonic, very popular. I'm sorry,
Mhm.
all the GPs are
Yep.
using it to go
Yep.
find founders. But the irony is, like, if everybody is using it, then the alpha is gone. So do I think like the end world is me building my own tools? Like probably. I just have to think. I just have to make sure that whatever I build needs to be different. Otherwise, I'm just going to do what everybody else is going to do.
Let's switch gears a bit on some quirky, fun things, some quick hits. Coolest thing you've seen in the last year?
Investment or just anything?
Anything that captures your attention.
Hmm. Single coolest thing. I'm a sucker for like production value and just like ridiculous concerts and raves and stuff like that. So I think Eric Prydz has like the best, like they basically does projection mapping onto like any screen and area where he does shows. And so I went to see a show and he's got like the most insane projection mapping thing where you're basically watching like 3D object come out and like eat you in the audience. Um,
Pretty
I thought
cool.
that was really cool. And then you realize you can actually do projection mapping at your house. And so I'm definitely gonna like have to invest in buying one of these things and start like projection mapping your room. You can go Google these videos on YouTube right now and like go projection mapping at home, and people just do the craziest stuff like inside their living room. You like map out all the big objects. Yeah, you're gonna want to buy. You're gonna text me after this, and you're gonna be like, I bought one. It looks really cool.
Very cool. Most exciting thing that's happened to you in the last year?
I had my second kid. I think that has
Congratulations.
to be the answer. If I didn't say that answer, I would gonna be in trouble with the wife later. Yeah,
That's
but and he's wonderful
consensus
and
and right.
consensus and right, exactly. I didn't want to get fired if I picked the wrong one there.
Yeah, yeah. Um,
What's the coolest thing that you've seen this year?
Coolest thing I've seen this year. It's not a tech thing. It's I have 4 kids, and it's watching them kind of, you know, every year they click a year on the age, and it's just this year's been special to see all 4 of them kind of hang without parents. So it's been kind of fun.
Hang
So
and,
that's
and,
been the
and kill
biggest
each
thing.
other while loving each other.
Yeah, or maybe in the other room, maybe, something else, and it's just yeah, they're able to do that, and it's fun. Favorite book you've read recently?
Favorite book I've read. Um, I'm a big fan of Morgan Housel. He just came out with The Art of Spending Money.
Oh,
It's fun.
insights?
We're just like a big mimetic culture. We all just spend money and want things that other people have. And the more you can shut off your brain to not base your spending decisions on other people, the better. Which ironically fits nicely with our conversation earlier on this podcast about, investing is everyone's just hiding from doing something weird. Spending is like identical. You're all just spending money so that you can fit in and do what everybody else is doing. It's a fun book because it sort of forces you to think like, if you just lived somewhere off the grid, or if you lived somewhere else, you didn't have the social pressure of your friends or anybody around looking at how you spent money, like, what would you do differently?
All right, so
Hey, no worries.
all right, West Coast, East Coast?
Well, I was born in Vancouver, lived there most of my childhood, and then now I live in Toronto. So I voted with my feet. What I tell everyone is like, Vancouver is the place where you go out and everyone's in bed by 10 o'clock because they want to wake up at 6 a.m. to go hiking. And then Toronto is the place you want to be if you want to stay out till 2 a.m. and don't care about going hiking. And well, I'm definitely more of the latter person.
There you go. There you go. You've quite the speaker setup last time I saw. So I can
It's
see
about to
that.
get better.
Yeah, I can imagine. Anything else that people would love to know about you that you don't think they would find out? I have one for you.
Please. What are you thinking of?
You are a very generous person, and every year you give gifts to all of your fund managers. I happened to be there one time, and you gave out this fantastic gift. I won't spoil it, let you describe it. And you saw my face and you saw my envy. And a year later, you gave me one too. So maybe just describe this thing.
And now it's in the mental office.
Yeah.
In 2020, I started a company that I wasn't sure what it was going to be. It's called Palace Palace Goods. We we were a luxury party goods company, and I invented, created, designed uh, a beautiful modern champagne saber made of beautiful stainless steel, reflective stainless steel, in a solid wood case, and then also a shot ski that had a ski that you do shots out of. But instead of looking like an old battered ski, it had magnets embedded in it, and so you could hang it on the wall with magnets, or you could use magnetic shot glasses and do it. So if it was on the wall, it just looked like a beautiful old pair of skis. And of course, when you wanted to use it, it was right there when you needed it. So we started this business in the middle of the pandemic, thinking the pandemic was going to last 4 months and then everyone would be ready to party again. And I didn't quite get the timing right. I had some good lessons in how to manufacture physical products, and so got both done. And now, unfortunately, sold out of both. But for those who are lucky enough, yeah, I have been known to give away what I think are the most beautiful gifts of these beautiful champagne sabers. I always feel like it's a little bit of a curse too, because then you end up spending a lot more money on champagne afterwards.
Well, you learn a lot about the seams and the bottles, and you start looking for them. So it's very special. Well, look, for us, I think we're grateful to have you on. I think I've learned a bunch here, and appreciate you spending the time.
Thank you for having me. It's been fun. And I've been a very happy mental client. And for those listening, I know this is the Mental Monday podcast, but if you're an LP listening to this and you haven't got a demo yet, you totally should, because it's made my life much, much easier.